Financial tenets. The financial tenets by which Buffett values both managerial excellence and economic performance are all grounded in some typically Buffett-like principles. For one thing, he does not take yearly results too seriously. Instead, he focuses on 5-year averages. Profitable returns, he wryly notes, don't always coincide with the time it takes the planet to circle the sun. He also has little patience with accounting sleight of hand that produces impressive year-end numbers but little real value. Instead, he is guided by these 4 principles. 1. Focus on return on equity, not earnings per share. 2. Calculate owner earnings to get a true reflection of value. 3. Look for companies with high profit margins. 4. For every dollar retained, make sure the company has created at least $1 of market value. Return on equity. Customarily, analysts measure annual company performance by looking at earnings per share, EPS. Did EPS increase over the prior year? Did the company beat expectations? Are the earnings high enough to brag about? Buffett considers earnings per share a smokescreen. Since most companies retain a portion of their previous year's earnings as a way to increase their equity base, he sees no reason to get excited about record EPS. There is nothing spectacular about a company that increases EPS by 10% if, at the same time, it is growing its earning base by 10%. That's no different, he explains, from putting money in a savings account and letting the interest accumulate and compound. To measure financial performance, Buffett prefers return on equity, the ratio of operating earnings to shareholders' equity. To use this ratio, we need to make several adjustments. First, all marketable securities should be valued at cost and not at market value, because values in the stock market as a whole can greatly influence the returns on shareholders' equity in a particular company. For example, if the stock market rose dramatically in one year, thereby increasing the net worth of a company, a truly outstanding operating performance would be diminished when compared to a larger denominator. Conversely, falling prices reduce shareholders' equity, which means that mediocre operating results appear much better than they really are. Second, we must also control the effects that unusual items may have on the numerator of this ratio. Buffett excludes all capital gains and losses, as well as any extraordinary items that may increase or decrease operating earnings. He is seeking to isolate the specific annual performance of a business. He wants to know how well management accomplishes its task of generating a return on operations of the business given the capital employed. That, he says, is the single best judge of management's economic performance. Furthermore, Buffett believes that a business should achieve good returns on equity while employing little or no debt. Buffett knows that companies can increase their return on equity by increasing their debt-to-equity ratio, but he is not impressed. Good business or investment decisions, he says, will produce quite satisfactory results with no aid from leverage. Furthermore, highly leveraged companies are vulnerable during economic slowdowns. Buffett would rather err on the side of financial quality than risk the welfare of Berkshire's owners by increasing the risk that is associated with high debt levels. Despite his conservative stance, Buffett does not have a phobia about debt. In fact, he prefers to borrow money in anticipation of using it farther down the road, rather than after a need is announced. It would be ideal, he notes, if the timing of business acquisitions profitably coincided with the availability of funds, but experience has shown that just the opposite occurs. Cheap money has a tendency to force asset prices higher. Tight money and higher interest rates raise liability costs and often force the prices of assets downward. Just when the best prices are available for purchasing businesses, the cost of money, higher interest rates, is likely to diminish the attractiveness of the opportunity. For this reason, Buffett says, companies should manage their assets and liabilities independently of each other. This philosophy of borrowing now in the hope of finding a good business opportunity later will penalize near-term earnings. However, Buffett acts only when he is reasonably confident the return of the future business will more than offset the expense of the debt. And there's another consideration, because the availability of attractive business opportunities is limited, Buffett wants Berkshire to be prepared. If you want to shoot rare, fast-moving elephants, he advises, you should always carry a gun. Buffett does not give any suggestions as to what debt levels are appropriate or inappropriate for a business. This is wholly understandable. Different companies, depending on their cash flows, can manage different levels of debt. What Buffett does say is that a good business should be able to earn a good return on equity without the aid of leverage. Companies that depend on debt for good returns on equity should be viewed suspiciously. Owner earnings. The first point to understand, Buffett says, is that not all earnings are created equal. Companies with high assets compared to profits, he points out, tend to report ersatz earnings. Because inflation exacts a toll on asset-heavy businesses, the earnings of these companies take on a mirage-like quality. Hence, accounting earnings are useful to the analyst only if they approximate the company's expected cash flow. But even cash flow, Buffett warns, is not a perfect tool for measuring value. In fact, it often misleads investors. Cash flow is an appropriate way to measure businesses that have large investments in the beginning and smaller outlays later on, such as real estate development, gas fields, and cable companies. Manufacturing companies, on the other hand, which require ongoing capital expenditures, are not accurately valued using only cash flow. A company's cash flow is customarily defined as net income after taxes plus depreciation, depletion, amortization, and other non-cash charges. The problem with this definition, explains Buffett, is that it leaves out a critical economic fact: capital expenditures. How much of this year's earnings must the company use for new equipment, plant upgrades, and other improvements needed to maintain its economic position and unit volume? According to Buffett, an overwhelming majority of U.S. businesses require capital expenditures that are roughly equal to their depreciation rates. You can defer capital expenditures for a year or so, he says, but if over the long period you don't make the necessary capital expenditures, your business will surely decline. These capital expenditures are as much an expense as are labor and utility costs. Popularity of cash flow numbers heightened during the leverage buyout period because the exorbitant prices paid for businesses were justified by a company's cash flow. Buffett believes that cash flow numbers are frequently used by marketers of businesses and securities in attempts to justify the unjustifiable and thereby sell what should be unsaleable. When earnings look inadequate to service debt of a junk bond or unjustify a foolish stock price, how convenient it becomes to focus on cash flow. But you cannot focus on cash flow, Buffett warns, unless you are willing to subtract the necessary capital expenditures. Instead of cash flow, Buffett prefers to use what he calls owner earnings, a company's net income plus depreciation, depletion, and amortization, less the amount of capital expenditures and any additional working capital that might be needed. But he admits that owner earnings do not provide the precise calculation that many analysts demand. Calculating future capital expenditures often requires estimates. Still, he says, quoting Keynes, I would rather be vaguely right than precisely wrong. Profit margins. Like Philip Fisher, Buffett is aware that great businesses make lousy investments if management cannot convert sales into profits. There's no big secret to profitability, it all comes down to controlling costs. In his experience, managers of high-cost operations tend to find ways to continually add to overhead, whereas managers of low-cost operations are always finding ways to cut expenses. Buffett has little patience with managers who allow costs to escalate. Frequently, these same managers have to initiate a restructuring program to bring costs in line with sales. Each time a company announces a cost-cutting program, he knows its management has not figured out what expenses can do to a company's owners. The really good manager, Buffett says, does not wake up in the morning and say, "This is the day I am going to cut costs," any more than he wakes up and decides to practice breathing. Buffett singles out the accomplishments of some of the best management teams he has worked with, including Carl Reichardt and Paul Hazen at Wells Fargo and Tom Murphy and Dan Burke at Cap Cities ABC, for their relentless attacks on unnecessary expenses. These managers, he says, abhor having a bigger head count than is needed, and both managerial teams attack costs as vigorously when profits are at record levels as when they are under pressure. Buffett himself can be tough when it comes to costs and unnecessary expenses. He understands the right size staff for any business operation and believes that for every dollar of sales, there is an appropriate level of expenses. He is very sensitive about Berkshire's profit margins. Berkshire Hathaway is a unique corporation. It does not have a legal department, or a public relations or investor relations department. There are no strategic planning departments staffed with MBA-trained workers plotting mergers and acquisitions. Berkshire's after-tax corporate expenses run less than 1% of operating earnings. Most companies of Berkshire's size have corporate expenses 10 times higher. The $1 premise. Speaking broadly, the stock market answers the fundamental question, what is this particular company worth? Buffett proceeds in the belief that if he has selected a company with favorable long-term economic prospects, run by able and shareholder-oriented managers, the proof will be reflected in the increased market value of the company. The same, Buffett explains, holds for retained earnings. If a company employs retained earnings non-productively over an extended period, eventually the market, justifiably, will price the shares of the company lower. Conversely, if a company has been able to achieve above-average returns on augmented capital, that success will be reflected in an increased stock price. However, we also know that while the stock market will track business values reasonably well over long periods, in any one year prices can gyrate widely for reasons other than value. So Buffett has created a quick test to judge not only the economic attractiveness of a business but how well management has accomplished its goal of creating shareholder value, the $1 rule. The increase in value should, at the very least, match the amount of retained earnings dollar for dollar. If the value goes up more than the retained earnings, so much the better. All in all, Buffett explains, within this gigantic auction arena, it is our job to select a business with economic characteristics allowing each dollar of retained earnings to be translated eventually into at least a dollar of market value. Market tenets. All the principles embodied in the tenets described thus far lead to one decision point, buying or not buying shares in a company. Anyone at that point must weigh two factors: is this company a good value, and is this a good time to buy it? That is the price favorable? Price is established by the stock market. Value is determined by the analyst, after weighing all the known information about a company's business, management, and financial traits. Price and value are not necessarily equal. If the stock market were always efficient, prices would instantaneously adjust to all available information. Of course, we know this does not occur, at least not all the time. The prices of securities move above and below company values for numerous reasons, not all of them logical. Theoretically, the actions of an investor are determined by the differences between price and value. If the price of a business is below its per share value, a rational investor will purchase shares of the business. Conversely, if the price is higher than value, that investor will pass. As the company moves through its economic value life cycle, the analyst will periodically reassess the company's value in relation to market price, and buy, sell, or hold shares accordingly. In sum, rational investing has two components. 1. What is the value of the business? 2. Can the business be purchased at a significant discount to its value? Determine the value. Through the years, financial analysts have used many formulas for calculating the intrinsic value of a company. Some are fond of various shorthand methods, low price to earnings ratios, low price to book values, and high dividend yields. But the best system, according to Warren Buffett, was determined more than 70 years ago by John Burr Williams in his book The Theory of Investment Value. Paraphrasing Williams, Buffett tells us that the value of a business is determined by the net cash flow expected to occur over the life of the business discounted at an appropriate interest rate. So valued, he says, all businesses, from manufacturers of buggy whips to operators of cellular telephones, become economic equals. The mathematical exercise, Buffett tells us, is very similar to valuing a bond. A bond has both a coupon and a maturity date that determines its future cash flows. If you add up all the bond's coupons and divide the sum by the appropriate discount rate, the interest rate of the bond's maturity, the price of the bond will be revealed. To determine the value of a business, the analyst estimates the coupons, owner earnings cash flow, that the business will generate for a period of time into the future, and then discounts all of these coupons back to the present. For Buffett, determining a company's value is easy as long as you plug in the right variables, the stream of cash flow and the proper discount rate. In his mind, the predictability of a company's future cash flow should take on a coupon-like certainty like that found in bonds. If the business is simple and understandable, and if it has operated with consistent earnings power, Buffett is able to determine the future cash flows with a high degree of certainty. If he cannot, he will not attempt to value a company. This is the distinction of his approach. After he has determined the future cash flows of a business, Buffett applies what he considers the appropriate discount rate. Many people will be surprised to learn that the discount rate he uses is simply the rate of the long-term U.S. government bond, nothing else. That is as close as anyone can come to a risk-free rate. Academics argue that a more appropriate discount rate would be the risk-free rate, the long-term bond rate, plus an equity risk premium, added to reflect the uncertainty of the company's future cash flows. But as we will learn later, Buffett dismisses the concept of an equity risk premium because it is an artifact of the capital asset pricing model that, in turn, uses price volatility as a measure of risk. In simple terms, the higher the price volatility, the higher the equity risk premium. But Buffett thinks the whole idea that price volatility is a measure of risk is nonsense. In his mind, business risk is reduced, if not eliminated, by focusing on companies with consistent and predictable earnings. I put a heavy weight on certainty, he says. If you do that, the whole idea of a risk factored OS&T makes sense to me. Risk comes from not knowing what you are doing. Of course, a company's future cash flow cannot be predicted with the same certainty as a bond's contractual coupon payment. Nevertheless, Buffett is more comfortable using the risk-free rate alone than adding several percentage points in risk premium just because a company's stock price bounces up and down more than the bounciness of the overall market. Still, if you are uncomfortable with ignoring equity risk, you can compensate by demanding a bigger margin of safety in the purchase price. Last, there are times when long-term interest rates are abnormally low. During these periods, we know that Buffett is more cautious and likely adds a couple of percentage points to the risk-free rate to reflect a more normalized interest rate environment. Despite Buffett's claims, critics argue that estimating future cash flow is tricky, and selecting the proper discount rate can leave room for substantial errors in valuation. Instead, these critics have employed various shorthand methods to identify value. Some, those we call value investors, use low price to earnings ratios, low price to book values, and high dividend yields. They have vigorously back-tested these ratios and concluded that success can be had by isolating and purchasing companies with exactly these accounting ratios. Others claim to have identified value by selecting companies with above-average growth in earnings. They are customarily called growth investors. Typically, growth companies possess high price-to-earnings ratios and low dividend yields, the exact opposite of what value investors look for. Investors who seek to purchase value must often choose between the value and growth approaches. Buffett admits that years ago he participated in this intellectual tug-of-war. Today, he thinks the debate between these two schools of thought is nonsense. Growth and value investing are joined at the hip, he says. Value is the discounted present value of an investment's future cash flow, growth is simply a calculation to determine value. Growth and sales, earnings, and assets can either add to or detract from an investment's value. Growth can add to the value when the return on invested capital is above average, thereby assuming that when $1 is being invested in the company, at least $1 of market value is being created. However, growth for a business earning low returns on capital can be detrimental to shareholders. For example, the airline business has been a story of incredible growth, but its inability to earn decent returns on capital has left most owners of these companies in a poor position. All the shorthand methods, high or low price to earnings ratios, price to book ratios, and dividend yields, in any number of combinations, fall short. Buffett sums it up for us: whether an investor is indeed buying something for what it is worth and is therefore truly operating on the principle of obtaining value for his investment. Irrespective of whether a business grows or doesn't, displays volatility or smoothness in earnings, or carries a high price or a low in relation to its current earnings and book value, the investment shown by the discounted flows of cash calculation to be the cheapest is the one that the investor should purchase. Buy at attractive prices. Focusing on good businesses, those that are understandable, with enduring economics, run by shareholder-oriented managers, by itself is not enough to guarantee success, Buffett notes. First, he has to buy at sensible prices, and then the company has to perform to his business expectations. If we make mistakes, he points out, it is either because of 1. The price we paid, 2. The management we joined, or 3. The future economics of the business. Miscalculations in the third instance are, he notes, the most common. It is Buffett's intention not only to identify businesses that earn above average returns, but to purchase them at prices far below their indicated value. Graham taught the importance of buying a stock only when the difference between its price and its value represented a margin of safety. The margin of safety principle assists Buffett in two ways. First, it protects him from downside price risk. If he calculates the value of a business to be only slightly higher than its per share price, he will not buy the stock. He reasons that if the company's intrinsic value were to dip even slightly because he misappraised future cash flow, eventually the stock price would drop, to, perhaps below what he paid for it. But if the margin between purchase price and intrinsic value is large enough, the risk of declining intrinsic value is less. If Buffett purchases a company at a 25% discount to intrinsic value and the value subsequently declines by 10%, his original purchase price will still yield an adequate return. The margin of safety also provides opportunities for extraordinary stock returns. If Buffett correctly identifies a company with above average economic returns, the value of the stock over the long term will steadily march upward as the share price mimics the return of the business. If a company consistently earns 15% on equity, its share price will advance more each year than that of a company that earns 10% on equity. Additionally, if Buffett, by using the margin of safety, is able to buy this outstanding business at a significant discount to its intrinsic value, Berkshire will earn an extra bonus when the market corrects the price of the business. The market, like the Lord, helps those who help themselves, Buffett says. But unlike the Lord, the market does not forgive those who do not know what they do. Anatomy of a long-term stock price. For readers who more readily process information visually, I created the graphic in Figure 3.1. It shows, in concentrated form, most of the key ingredients of Buffett's approach. A great business, center column, over time, the x-axis, will produce rising shareholder value. The y-axis, as long as it is bought at a good price, left-hand column, and managerial decisions, right-hand column, avoid extinction in the market, do better than simply matching market rate, and instead lead to increased value in the company. To witness these tenets in action, refer to the case studies in Chapter 4. The Intelligent Investor. The most distinguishing trait of Buffett's investment philosophy is the clear understanding that, by owning shares of stock, he owns businesses, not pieces of paper. The idea of buying stock without understanding the company's operating functions, including its products and services, inventories, working capital needs, capital reinvestment needs, for example, plant and equipment, raw material expenses, and labor relations, is unconscionable, says Buffett. In the summation of The Intelligent Investor, Benjamin Graham wrote, "Investing is most intelligent when it is most businesslike." These words are, Buffett often says, the 9 most important words ever written about investing. Investors have a choice. They can decide to conduct themselves like the owner of a business, with all that implies, or spend their time trading securities just for the sake of being in the game, or indeed for any reason other than business fundamentals. Owners of common stocks who perceive they merely own a piece of paper are far removed from the company's financial statements. They behave as if the market's ever-changing price is a more accurate reflection of their stock's value than the business's balance sheet and income statement. They draw or discard stocks like playing cards. Buffett considers this the height of foolishness. In his view, there's no difference between owning the company and owning a share of it, and the same mentality should apply to both. I am a better investor because I am a businessman, confesses Buffett, and a better businessman because I am an investor. Buffett is often asked what types of companies he will purchase in the future. First, he says, he will avoid commodity businesses and managers in whom he has little confidence. What he will purchase is the type of company that he understands, one that possesses good economics and is run by trustworthy managers. A good business is not always a good purchase, says Buffett, although it is a good place to look for one.